It was a rude shock the Indian industry got this week. As the first quarter results of corporate India for 1998-99 started coming in, blue chip stocks slumped on the capital market. Corporate steadyboards Tata Steel, TELCO, ACC, SAIL, IPCL and Ashok Leyland had posted all-time high losses in the first quarter of the financial year. While TELCO posted a profit of rupees 90.5 crores in the first quarter of 97-98, this year it registered a loss of rupees 35.63 crores. And as IPCL reported a loss of rupees 56 crores, ACC's net profits dipped 51%.
If one looks at the corporate results, one sees that about 25% of the companies are making losses. That was for the first quarter. Normally, in a normal year, the loss-making companies should not be more than 5 or 6%. So the very magnitude of the loss-making companies indicates that the situation is rather, getting out of hand.
Originally, we hoped that the economy will grow around 7%. Now it is not likely that we will grow by 7%. We may grow anywhere between 5 to 6%. The industrial growth will also be there. Instead of 12%, it is likely to be between 4 to 5%.
Post-liberalization, it was boom time. Indian corporate houses were going global and the country looked set on the road to economic gigantism. Less than a decade down, initial euphoria has transitioned from subdued expectation to skeptical despair.
Until and unless we can be investor friendly, and we cannot become investor friendly without a requisite policy. Of course, the industry has also to do a lot, but so far the government and we have not been able to come to a common objective to revive the capital market.
While analysts maintain that poor performance of the industry is linked to slow economic growth, recession and lack of political initiative, observers contend that political instability compounds the problem.
If the political structure is such that it engenders a lot of turnover of governments, governments come in for a short period, short stretch, but yet do not maintain a very strict stability in the growth path of the overall policies that are followed. This creates a lot of problems for planning ahead for corporates.
A factor common to most firms that have reported losses is that while production volumes and sales revenues have fallen, interest costs have gone up. While sales interest cost went up from registered rupees 388.46 crores last year to rupees 437.15 crores in the first quarter of this year, Mahindra & Mahindra's interest cost increased from rupees 28 crores to rupees 36.7 crores. Those in the know feel that the slump in the capital market has forced companies to turn to debt financing. Public issue of debt were recorded at only 25% in 95-96. However, in 1997-98, it accounted for 61% of total fund raised from the capital market.
Company always prefer to go in for equity. But the present share market being what it is, the market for new issues has almost vanished. No company can go to the market and raise equity. So it is forced to rely on debt financing.
Some analysts, however, feel that the private sector failed to meet the challenge posed by the transition from a protected sellers to a competitive buyers market. Even as the Indian industry reels under the shock of the slide at India's most fashionable corporate addresses, the moot question is, can the business come out of this recessionary phase? And while corporate India hopes that the slump is only temporary, it sure looks like a tough road ahead for the industry. It is a revolution on four wheels that is hitting India. In 3 months' time, the country will see national and international fantasies on wheels hit the road. And and the small, sleek dream machines are set to trigger off a big, mean race with a drive. With the Indian middle class, whose motto is quality at affordable price, finally deciding to take the car plunge, the small car segment seems set to become exciting, promising nail-biting finishes.
Size of the market is limited. It's not grown as people have expected. It's about a little over 400,000, and it's not shown the growth rates one had imagined at least 2 years ago. And what's happened is that a lot of players have come in, so it's basically too many people fighting for too small a pie. So there's definitely going to be a pretty intense battle on this front.
For years now, Maruti has been the dream machine for the Indian middle class. It not only changed the way India drove, it also changed the way India saw its cars. And now the market leader faces some serious competition. While Hyundai's Santro fired the first salvo, more car manufacturers have lined up their products for the coming year. Daewoo Motors, which entered the Indian market in the mid-luxury car segment by launching Cielo, has its small car Matiz set to roll the roads. And close on its heel, India's truck giants Tata will release the country's first indigenous small car, Indica.
The car war start, and more and more players are coming to Indian market. I think because the Indian automobile market has that future, and I don't think everybody thinks that the Indian automobile market has room to play with.
New entrant like Hyundai, Mitsubishi, and Daewoo small model, and TELCO, Fiat. So with the introduction of the various models, through our experiences in the past, the market will become active.
The tables have been turned, and the rules of the game which Maruti decided almost a decade ago, like technology, comfort and price, seem to be looking at the market leader in the face.
Essentially what the Indian consumer is looking at, especially in this price bracket of 3.5 to 4 lakhs, or let's say below 4 lakhs, is a lot of value. They want more car for less money, and I think essentially what that means is manufacturers are going to pack in a lot more features, give a lot more value-added items, and I think really that's what's going to decide who's going to win this game.
However, with Maruti holding 83% share of the rupees 10,000 crore car market in India, it looks like a tough battle ahead for the new entrants. Forecasters put the annual sale of cars by the turn of this decade at a whopping 8.75 lakhs per year and project the market to grow to approximately 13 lakhs by the year 2005.
Indian automobile, car consumers will change, and how fast the change that I do not know, but it definitely will change.
In proportion to increase the income and the change of lifestyle, the customers would like to upgradation.
And as dreams on wheels roll out of showrooms across India, the great Indian middle class fantasy seems set to be answered. But in a market driven by hard bargains, car manufacturers will have to perform or else fall by the wayside. These engines will not roar again. For World War II vintage Harley-Davidson motorcycles converted into public careers, these are the last days of existence. For more than 4 decades now, they have ferried people, provided a source of income to its drivers, and gave an identity to the walled city of Delhi. They have seen the city grow, saw the faces changed, and chronicled history on its way. Their vintage charm captured on camera, Their images made him mortal. But by the time these images reach our living rooms, they will be history. Forced to quit by a court order that bans the use of all vehicles that are more than 20 years old. Darshan Singh has been on the wheels of his Harley since 1952. His life intricately revolving around his vehicle and taking turns with it. He has nostalgic memories associated